Good morning, everybody. I'm Mark Sebastian. I am your only option. I am the founder and chief executive officer here at Option Pit. I've been a professional trader for 20 years with an expertise on VIX, volatility, equity, vol, zero DTE options. I started trading those before anybody else, basically, in the business, and that's really what I'm about. I follow volatility, I follow equity volatility, I follow big money flow, and I trade short dated options. It's a lot of fun and a lot of action. And today, we're here to discuss the state of the market and what is happening, where we are. I'm going to break down exactly why we kind of stopped rallying, why volatility stopped going down. I'm going to explain to you why it's so important and then what to do in this market. So, with that, we can dig in right now. If we want to share my screen, the S&P, really nice kind of V-shaped rally here that's now stalled and basically has been stuck in place since May 13th. So call it about a week's worth of trading days. Similar pattern in the triple Q. The Dow, and even the Russell 2000. So what gives? And what's with this pattern we've had the last 3 days of opening down and then rallying? You're saying there's been a pattern, Mark? Yeah, there has. Last 3 days. So I'm going to go to my 5-day chart. Look at this. Here's Friday, down, and then rally. Here's Monday, open down, rally. Tuesday, down. Kind of get a little further soft, but then basically get back to where we were. And today we're opening down, and you can see we're rallying. What's behind that? It's nothing that should be ignored. It's nothing that should be ignored because it's bigger than the stock market. It's bigger than the option market. It is the bond market. And there are 2 ETFs we can use to look at the bond market. IEF. This is an ETF that holds U.S. Treasuries with a duration of 7 to 10 years. The second one is TLT, and this holds bonds with a duration greater than 20 years. So think of IEF as the 10-year and TLT as your best ETF for the 30-year bond. Why are these important? Well, interest rates affect everything. Bond prices affect everything. And bonds and credit in the United States is directly tied to what you're looking at on my screen. Bond prices. Treasury yields go higher. Mortgages go higher. Business loans go higher. Student loans go higher. Even short-term credit, things like that. Everything goes higher. Borrowing costs, costs of capital equipment, trucks, cars. Borrowing costs go up. Car prices in particular are something that should be paid attention to. Do you know how expensive the average car is in the United States now? like $50,000. $50,000. So, somebody making $100,000 is likely taking out a loan if they're buying a new car. So now they're taking out loans 6 to 8 years at these much higher interest rates. It is absolutely, a cascading effect, right? 5% on a $20,000 car adds up to, maybe a couple bucks a month in your payment. 5% on going up to 5% on your loan for a $50,000 car, that's starting to affect things. So that's why interest rates are so important. The other reason, and this is the traditional reason you pay attention to interest rates. All right. So we already know interest rate scares affect markets. And I'll show you another proof here in a second. So interest rates go up, markets get more volatility. What does that encourage people to do? Leave the stock market and go get treasuries that are paying a guaranteed 5% or more. So, then you get this cascade on the stock market. So, and that's usually, and then if eventually enough people leave the stock market to buy bonds stabilize, stock market stabilizes. All right. So let's take a look at a period of time where bond prices were not great. And I want to point you to the year 2022. Anybody remember 2022? It was not a great year for the stock market. This is the last time TLT had an extended bear market. Got all the way down to 82. All right, 82 is going to be the equivalent of like 5.25% on the 30-year. Well, that same period of time, it wasn't exactly, gumdrops and lollipops. I mean, look what the stock market did over that same period of time. We dropped almost 1,200 points. We did rally back, and then bonds started tanking again, and we get another dip down to 4,000. Ignoring the bond market is like, it's a one-way ticket to seeing the forest, not being able to see the forest through the trees, because bonds are the forest, everything else is the tree. So now you understand kind of where bonds are and why. All right, what do you need to look out for? All right, I keep an eye on treasury yields very tightly. And this morning, and these are big areas here, guys. We've not closed above 4.5 yield in the 10-year since 2003 and 2023, excuse me. And the 30-year, 5.25, that would also be 2023. So you have some real risks here, where if we kind of close above those levels, because we flirted with them and then bounced. So if we don't bounce, this is a tipping point where people start to wonder if the Fed has lost control. So how do we know if the Fed has lost control? This is Treasury Direct. This tells you when upcoming U.S. Treasury bond auctions are. And we got a couple of big ones coming up. This one is today. $16 billion in 20-year bonds. This auction is kind of going to determine where that 30-year yield goes. And, you could get further follow through on this 10-year bond note. It's a tip, but it's still a 10-year tip. How that auction looks. And that's $18 billion. So we've gotten these bounces over the last few days because treasuries have managed to recover. When they don't, we have a problem. But at the same time, what if these auctions go well? What if people calm down about the budget and, a few weeks from now, bonds are back at, closer to a 4% yield, the 30 years down toward 4.6. Entirely plausible. Where's the market then? Right. So it's one of those where you're like, we've had this nice run and they're begging you to go short or short the market. But at the same time, it totally could be setting up as a bear trap and the market just ripping. Right? So what do I do? Well, a market like this is not a play. You have to be very tactical to be a premium seller. One of the reasons why, until I met Hans, we never had an income product, because I had not met anybody that knew what they were doing enough and was tactical like Hans. But outside of having a guy like Hans, this is not a market for option selling. It's a market for option buying. Now, you're saying, Mark, but look at this. Look at the move we've had in the VIX. Volatility is way down. VIX is all the way down to 18. And it looks like it wants to go to 15. And I would say, we could just as easily, if the budget deal falls apart, rates explode, it could go right back to 25. And they would go, yeah, you're right. But Mark, with the VIX still up around 19 and me believing it could get to 15, when historically it hangs around 12 or 13, what makes you tell me this is a market to buy options? And the answer is movement. All right, I'm going to show you a couple of charts here. All right, this is the S&P 500, and this is running historical volatility. The light blue is 10-day or 20-day. The dark blue is 10-day. And over the last 10 days, we've been moving at a volatility of about 15.57. 20-day, even lower, 1480. And then you go, hey, wait a minute. You just said you want to buy options. And VIX is 1865, a good measure of how much option costs. Right? I always tell you, think of VIX as our measure of option pricing. So you're saying, Mark, option prices are 1865. And then think of HV as a measure of how much options are worth. And the options are only worth, over the last 20 days, 1480. Why do you want to pay 1865 for options worth 1480? And my response is, looking at, the HV measurement you're looking at measures close to close pricing. How much should we move? We closed here. The next day we close here. How much did we move? But that's not really the story of the market. The story of the market is the total movement throughout the day. And the total movement throughout the day on a daily basis, the S&P 500 is moving 78 points. All right, well, 78 divided by 5,900, about 1.3%. If you move 1.3% a day, that's a 21 VIX. That's a 21 value for options. Now, I'm not going to dig into the calculation on that, but you basically just take this number and multiply it times 16. Yeah, 21. So, when we look at it this way, option prices in this market are cheap because, one, we're moving around a lot. And VIX, our measure for option prices, relatively low. So what do you do about it in this market? This is a market for strangle trading. You're asked, what is strangle trading? All right. So if I think options are cheap and the S&P is going to go up, I buy a call. When I think options are cheap and I think the S&P 500 is going to go down, I buy a put. Super easy. But what do I do when options are cheap, but I don't know what the market is going to do? We could go up, we could go down. what would I do? Well, if I buy a put and I buy a call, if I buy them at the money, that's called a straddle, but it's also a form of strangle. And if I buy kind of slightly out of the money around where the underlying is trading, like the S&P, then that is called a strangle. So with the S&P up here at 5,900 and knowing we have non-farm payrolls on the second, on the what is that? What are non-farm payrolls? They're the 6th. On the 6th, I might look at going out and buying something like the 58.75 put for $60. We're right at 59 or 59.15. So, and I might look at buying the 59.55 call for, $62. So that'd be like $12,000. Don't worry, you can do the same thing in SPY. And if that's too rich for your blood, you can go to the June 6th, about 3 weeks, and kind of a similar story. We're trading 590, 587 put is $6.25. 593 call is $7. There's your strangle. And now, if we get a move, I'm in business. So you might ask, Mark, what, I want to look at the, I can do that quickly in the S&P, but how do you evaluate that on other stocks? Do you just go one by one and find stocks that you think are cheap and see if that measurement adds up? No. I build scans. So this is a scanner I built where I will trade strangles off of this. It pulls names where that volatility that I just discussed with you is flashing. These options are too cheap. So between being able to quickly do it in the S&P 500 and then having a couple of scans that actually find this stuff for me, now I'm in business for some strangle trading. So you're saying, Mark, how do I learn more about strangle trading? Well, one of the things that we haven't really talked about in Rip Zone is that it's actually 2 products with 2 trade ideas a week. Every week, Andrew comes up with 1 or more of the absolute best volatility-based trade for that week, using his 4 criteria. He finds that best idea. All right. What we haven't talked about is that another way of trading rips and trading these rip zones is through equity vol. So not just the VIX, but equity volatility. So option prices on Apple, option prices on Google, option prices on NVIDIA. And I'm going to be working with you guys on Tuesdays, learning how to trade option prices versus what options are worth. And so we're going to be strangle trading on top of what Andrew is doing. And I'm going to be doing my first session on Tuesday. I'm going to teach you everything you need to know about strangles in the process, the goal of which is to teach you how to do it yourself and find more trades than just the one I give you every week. So if you'd like to join us, I would invite you to click the link that is above me in this presentation, above me in the state of the market with that green thing, and it says click here to join. Or you can click the link that I just pinned to the top of chat. If you have more questions about it, give my team a call, 888-872-3301. If you're a current client or you are you have some different questions about the service, 888-872-3301, or you can email them, support@optionpit.com. Once again, you're getting 2 for the price of 1. And that is, something that, normally we don't do. So you're going to get this product that is eventually going to be its own standalone, included with Ripzone. So there you have it, everybody. Today we walk through why the bond market is so important, what you need to look for, what you need to pay attention to, how it affects markets, why it's so important. We talked about what I'm looking to do in this market and why I'm looking to buy options and not sell. And of course, we talked about a little bit about the fact that Ripzone is not just one product, but it's 2. My Strangles trading service, where I'm going to teach you how to find trades where the option prices are less than the options are worth. All right, everybody. One more time, click the link that I just pinned or the one above me. If you got or call my team, 888-872-3301, or email us, support@optionpit.com. I'm Mark Sebastian. I am your only option. Have a great day.